Ladies and gentlemen, today's training is with Mr. Joey Wilke. Joey Wilke is a residential mortgage loan originator, and he's actually a broker. So he works with 168, 169, I think he said during our call today, different lenders with over 4,000 different programs. This is a fantastic call that you don't want to miss because we talk mostly exclusively about what's called non-qualified mortgages, the people that don't fit into those federal boxes like FHA, VA, whatever it might be. Maybe their credit's a little bit messed up. Maybe they they changed jobs recently. You know, those little things like that. What do you do with them if they don't get an FHA loan or if they can't get a conventional loan or something like that? We have to start looking at what's called non-qualified mortgages. And Joey has some amazing products out there, especially for investors. I was geeking out the whole time listening to what he had to tell me, and I'm going to be talking to him a lot. I've got notes galore here. He's got what's called debt service coverage ratio loans that they'll go down to a 75% coverage ratio. Or 0.75, excuse me. That is insane. Like I cannot stress how amazing that is right there. They have fresh start ones if you're starting a new job or if you're coming out of it. So people that are new and they just got a good job, but they've never really done it before, they've got loan programs for that. They've got fix and flips. They got live-in flips. They can get down to a 500 credit score. They can help you get your credit score back up. You are going to want to watch this in its entirety. And if you've got a client that is having a problem getting a loan, I think you're going to want to watch this, and you're definitely going to want to talk to Joey. And if you are an investor like we encourage here at White Line, you're going to want to become very good friends with Joey because these loan programs, the rates, the numbers that put it all together, I'm geeking out. So watch the video. I think you're going to like it. Give Joey a call.
Ladies and gentlemen, today I have Mr. Joey Wilke. I know it says Christopher Wilke, but I've never called him Christopher a day in my life. He comes from the old school with me and Eric. I think last time I actually got to put my paws on Joey was probably 1900s. If I have to be completely honest.
Yeah, it probably started in 19s. Yeah.
Yeah. So anyway, so Joey's been working in the mortgage industry for a little while now, and him and I got to talking the other day and about talking about non-QM loans. And what he had to say was extremely impressive, and I really liked it, so I had to get him on here. Plus, he's just an awesome guy to know, and all of you agents need to know who he is. So it's really, really going to be helpful. But before we get started, Joey, introduce yourself. Tell everybody what it is that you want them to know about how awesome you are, and
all right,
where you come from, and all that good stuff.
Well, thank you for the very kind introduction there. Some crazier times back in the day that we could talk about, but yeah. So my name's Joey Wilke. I'm with Nexa Mortgage. We are a mortgage broker, and by being a mortgage broker, I represent over 160 different lenders. We have over 4,000 different loan products. Now, I don't know all of them, and I don't use all the lenders, but it gives me options. And one of the main options we're going to talk about today is non-QM loans. A non-QM is basically a non-qualified mortgage, which means that it's not going to be sold through Fannie Mae or Freddie Mac on the backside after it comes through your lender. So it's usually a portfolio product. The people that are lending have their own investors, and so it gives us more flexibility. So it's not your straight up STREAMLINE, good FICO score. Debt to income ratios are gonna be a little more lax, and they have different options. Specifically, a very popular loan right now is called a DSCR loan, which I was going to go over today. That's a debt service credit ratio. And the awesome thing about this loan is that it's going almost 100% on the property itself. The property is used to secure the loan. You look at the loan from basically what the property is going to rent for. So if your rent's going to total $1,000, then that means you can afford a property that's going to cost you $1,000 a month. It's basically what a DSCR loan is. It doesn't matter how much you make. They do check your credit score just to make sure that there's nothing really crazy on there, like a recent bankruptcy or a deed in lieu of foreclosure or anything like that. But so a DSCR loan has become very popular, especially now in times of inflation and rising prices. So I think we'll touch a little bit on that. Other than that, come from the world of industrial electronics, moved into real estate. My wife and I did a real estate team. We're real estate agents for a while. We went through 3 different lenders. I think Colin and I talked about it. I actually remember there was a 4th because I did a couple hard money things and did a little investing myself. And we never really found somebody that did everything that we liked. Either they were awesome at getting people approved and no communication, calling me the day before closing and saying, hey, your borrower needs to bring $6,000 to the closing table, which they didn't have, or not being able to get people qualified because they had their own overlays. I had some VA clients that got denied because their credit score was below 620. Well, VA doesn't require a credit score. It's just something that a lender will put on top of there to protect themselves. So we have all kinds of different options. My job is to help you get your client qualified, and I do that by looking at our different lender options and educating you on the programs that are out there. Because quite frankly, until I got into mortgage, I really didn't know all these existed. And so,
right.
If you don't mind, if I can share my screen for a few minutes.
Yeah, hold on real quick before we share
Okay.
that screen. I'll turn that on in just a second. I want to unpack something real quick that you mentioned earlier. So we've got a very interesting mix here at White Line Realty, right? We've got a lot of really experienced realtors. We've got a lot of investors that hold their realtor license, and we've got some babies that are pretty new to the game. And so for the people that are new to the game, so their mortgages, whenever you go get a loan for a house, right? That's a mortgage. So if anybody doesn't know, it actually comes from the words mort, engage, which means you're literally engaged until death is how that actually translates, which is kind of funny.
I just learned that too.
Yeah. So, so when they fall into two categories, just right out the gate. Okay. So we've got a qualified mortgage, right? And a qualified mortgage means that the federal government has got some sort of guideline that's attached to that. Okay. Am I explaining that pretty ridiculously simple?
Yes, sir. That's
So all the letters that you've ever heard of tend to be qualified mortgages. So if you've heard FHA, VA, all those kind of things, anything you've probably heard of before, those tend to be qualified mortgages. And so that means to get inside that box, there's certain things that the federal government has outlined for you to get a loan, right? And the reason why they do that is because the government is actually backing that loan in some capacity. So if the government's going to back that loan, they have qualifications, which makes it a qualified mortgage. Okay. And then what Joey said a minute ago, guys, just to kind of separate this. So Joey might do an FHA loan. Okay. And if you've ever bought a house, you know exactly what I'm talking about. This mortgage gets sold almost immediately on a secondary market. When we say secondary, it just means like you just don't know about it. They're not calling Joey and asking his permission. It's just kind of happening. And they sell those through the companies or through the organizations, Freddie Mac, Fannie Mae, Ginnie Mac. There's a bunch of different ways that they go about selling those. So guys, that is a qualified mortgage. And for the longest time, for the last 20 years, probably 40 years, that's kind of been the majority of loans. Now, with the economic climate the way it is, and I'm not trying to get political, but we've got inflation going up, we've got interest rates going up, we got house prices surging like crazy, gas prices are up right now, and I don't know how long this is going to be, relatable, but as of today, we are just seeing everything tick up very quickly, which makes fitting in that box trickier and trickier every single day. So what we're going to talk about today, so Joey, correct? Joey, you do FHA, VA, and all that kind of stuff, correct?
Yes, sir. Yeah, sure.
Right. And we've talked about that before a lot on these classes and these lunch and learns. But today we're going to talk about the other box. What do we have to do to have a non-qualified mortgage, a non-QM mortgage? And so that's what we're going to be talking about today. So just unpack it and enjoy it. And so non-qualified means we really don't have to follow the federal guidelines. Exactly. Period. And so what Joey mentioned earlier is he said these tend to be portfolio loans or private loans, meaning a bank is making the rules now, not the federal government. Joey, I'm sure you have some private investors or like hedge funds or things of that nature that the government's not backing. It's just a big old pool of money. And they said, hey, Joey, if you can find us anybody that fits in this box, we'll give them money. You find anybody that fits in this box and it doesn't tie to the federal guidelines. Am I explaining this about as clear as I can?
That's the best way to explain it. It's exactly like
so,
that.
Yeah. So today, guys, so Joey does all of that. If you got a question about a VA, FHA, please don't discredit Joey. He knows all that stuff really well. We've talked a lot about it. So let's talk about the other side that nobody really talks about, which I think is going to become really, really important over the next 3 to 5 years. I honestly think that's what's going to happen is we're going to have a lot of people qualifying are getting non-qualified loans, non-QM loans. So Fannie Mae and Freddie Mac, until the government makes some sort of intervention, it's going to be harder and harder to get those. So Joey, let me how do I get this doing? Sorry guys, I think I told you that my screen. Or can you share your screen on there, Joey?
Let me give it a look. No, not yet.
I want to make you the host, and that way you can do what you got to do.
Okay.
How's that?
Yeah, should work here.
Is it doing it for me?
I think so. Can we?
There we
see
go.
this
Show
now?
us your screen. Talk to us about this.
All right. So I didn't have a fancy PowerPoint or anything prepared yet. You know, I just wanted to
Oh,
talk
come on.
about.
I gave you at
different
least like 3 hours notice.
Yeah. So and that's a little bit about being a broker is you know, I shop different lenders. I have about 5 or 6 different lenders I like to use. Like I said, there's a ton of them that I have access to. And so this material usually comes directly from them, because all I'm doing is I'm working for you and I work for the borrower. And then I'm linking you to the investor. Like Colin said, a lot of them, the banks or the hedge funds, they put their own parameters instead of the government telling the lender what you can do in a qualified mortgage, like a FHA loan or a VA loan. They set their own parameters to protect themselves. And so this is kind of what that covers. And so the first one that comes up is an unconventional DSCR, like we said, a debt service credit ratio. Now, the craziest thing is, and I had to get a little bit of clarification on this morning. So your debt service credit ratio is if you have a house that's going to rent for $1,000 a month, an investment property that you're looking at, or you own it now, and it has $1,000 a month, that basically means they will loan you up to $1,000 a month mortgage. And so that might work out to, you know, $125,000, $150,000 loan.
Yeah, let me just real quick time that out. So guys, whenever he says the words debt service, he's talking about the debt on the house. Okay. And solely the house. You'll hear another term in mortgages a lot calling DTI, or debt to income. That's not what he's referring to here. This is a totally different set of scores. This is the debt service on the house. How much does it cost? What is your, in a debt service, Joey, correct, if I'm correct, is principal, interest, taxes, and insurance. That entire, the PITI, right?
Yeah. And they've now added a new one. And a new one is, they call it an A, so it's PITIA, and that stands for any kind of HOA dues, since HOAs have gotten kind of popular. So,
gotcha.
So PITIA. But yes, anything that your basic cost of actually owning that house, the monthly cost, if your home, this loan will go up and pay for that. And so that's what your DSCR ratio is, like we said. So your principal, interest, taxes, insurance, and HOA fees. And typically a DSCR, recently they've started going down, like you see right here on the very first one. Your level can be in 0.75. Now this is kind of crazy. I had to get a little bit of clarification on this. Why would they lend you something that your rents aren't even going to cover your basically your debt service? So your house is going to cost you $1,000 a month payment, but your rents are only going to be $750 a month. Why would they do that? Well, they see it as maybe you bought the worst house in the best neighborhood, and they know that your rents will be going up very shortly, or it might be need a little bit of cosmetic work. It's not a fix and flip loan. It's not something for you're going to do a complete rehab, but maybe it needs a little bit of updating or something like that. And so after you update it over the next 6 months or so, your rents will be going up. So this is, again, it's not an in the box loan. So these lenders have more flexibility. So you can go find a property that needs a little bit of work, not a complete overhaul, and put in an offer, or find a property in a great neighborhood that you want to turn into a rental. And you can go get it with just, you know, even less than what it's going to rent for now, what your rents now are going to pay for in the future. And so they're willing to do that. Now, typically your typical one is going to be a 1-to-1 ratio. Your rents are going to be $1,000 a month. They'll lend you up to $1,000 a month.
I got to interrupt there, because that So, just for the agents out there, I'm sorry to interrupt, Joey.
No.
I have never seen a DSCR loan that was less than 1.2.
Right.
So, guys, meaning if my total debt service is $1,000, I better have $1,200 a month in rent. That's the lowest I've ever seen. When we were talking the other day, and he said, "Oh yeah, I got somebody who'll do 0.75." I was like, "What? That makes zero sense to me." Kind of like you just said there too. I was like, "What?" A literal head scratcher.
And there's there's about
One-to-one's
there's about
huge, you know.
20 different investor partners. We call them investor partners, but they're actually lenders, and most of them, about 15 of them, do require a 1.2. But now with I guess inflation and why would they do that? Well, house prices went up 18% national average last year. The year before that,
19% here in San Antonio.
yeah, yeah, and so that's what they're seeing. Okay, well, we'll even do an interest only, so you can do it interest only, where you're not paying down any of the principal, but you're getting in this house before the price of the house goes from 150 to 250, over the next 4 or 5 years. So you've already got the house secured and you're paying interest only. But okay, in 3 or 4 years, you can refi it, and you can refi it again with a DSCR, pull some cash out, and you'll start paying down on the principal.
And I really hate to go down a rabbit hole here, but Blackstone was the one who set the precedent for that. I don't know if y'all have read that. I've got the book over here somewhere. What is the name of it? You have got to read this book. It's called What It Takes by Stephen A. Schwarzman. There it is, What It Takes. And he's the guy who founded Blackstone. He raised some bajillion dollars to buy houses after the 2008 housing crisis. And he made a ton of it. So these people are out there knowing that the house prices are, they're willing to take the risk. Because you know what? I'm going to take that house. I'm going to sit on it, make 20%. I'm done.
Right.
So yeah, that's where that's coming from. I know it sounds crazy, people. And if you study this like I do, if you're a nerd like I am, it's like, what are you talking about? But the patterns are showing that kind of risk is acceptable right now.
Yeah, and y'all, some of y'all are very experienced. Y'all know a lot more than I do. But I just know that this is becoming the wave. Like Colin said, this is becoming the wave. This is the way that people are moving. The people that have the means and have the foresight are buying into real estate, because rents are only going up and home prices are only going up. So this particular one, they call it an unconventional DSR. Like your typical is a 1-to-1 or a 1.2, like a $1,200 a month rent ratio to $1,000 a month expense ratio. But so they'll go down to 0.75 in certain situations. This rate sheet was made in February, so most of our rates are in the 5s now, the low 5s, and it just kind of depends on the LTV. And the LTV is the loan to value ratio, and that's easy to explain. Is in the same way, using round numbers. 70% LTV is if your house is worth $100,000, they're loaning up to 70% of that. So you do have to come out of pocket with some of the down payment. If you have a little bit higher credit score, 640, again, that's really the only thing that they're going to be looking at as you as a borrower instead of the property. Is they're going to kind of check your credit score to make sure that there's nothing too crazy in the recent future, and that's really about it. And then they're going to look at the property's value to the actual loan that they're sending out to you. They do have you do have to put in a little bit of skin in the game. They'll go all the way up to purchase transactions. This lender does 80%. Most of my lenders will do 85%. If you have, a FICO score 650 or above, this one's 660. No prepayment penalties. And like I said, no income and no employment verifications. What that grades for is somebody like me who's a 1099. A lot of loans require you to be, and have a W-2 or 1099 income for 2 years. So when you're self-employed, these kind of options become much more viable.
I just, guys, okay. So let me explain why this is so huge. Like Joey's looking at the number side, and he's doing a great job of explaining it. Yeah. But I need to put this into context in a day-to-day environment. I am self-employed. Now, I've been self-employed for many years now, so I'm fine. But if you're new to this real estate game, and let's say you just like, screw this, I'm quitting my job, I'm going to go do this, I'm going to sell some real estate for White Line, and I'm going to get an investment property. If you have not been working for White Line for 2 years, or whatever your job is, and you can show tax returns of you making X amount of money, then nobody's going to talk to you. That is one of the most dangerous things about all of those qualified mortgages is they want 2 years of work history, either with the same employer or in the same industry. These guys don't care. They don't care, which is fantastic. So Joey and I were talking yesterday. I said in my house, like I bought a house, I don't want to say 14, 16 months ago. I bought it on a hard money loan, interest only, and I fixed it up. My interest only loan on this thing is so low. I just haven't taken it out of the hard money loan. I have a 2 year horizon on it, and my payment's $415 a month. and I'm charging $900 a month in rent. It's a great little deal for me, but I can't sit interest only forever. That's dumb. So they're going to say, Colin, what's your credit score? Great. How much you charging in rent? Great. And guess what? Transaction's done. Like, that's it.
That's it.
And that, guys, that is huge if you're getting into investing, especially because everybody always, the big question is how do I get these BRRRR properties or whatever it is to work?
How do I get started?
How do I get started? This is how you do it, guys. If you haven't been, because the next thing is, you know, if you go to a bank and if you go in there to try it, if you walk into Wells Fargo or whatever, I don't care, and you say, hey, I want to get a loan, and you want a portfolio loan, which means the bank's going to lend you the money directly, they're going to dig so far up your rear end. They want to know, how long have you been investing? Do you know this? Do you know that? Do you know? It was really funny. I went and looked at a convenience store the other day that somebody wanted to buy, and the first question of the banker's mouth was, what do you know about running convenience stores? I'm like, yeah, I don't know. But what Joey's saying here is if the convenience store makes enough money, he doesn't care. Yeah. You know, that's the end of it.
Yep. If they show, yeah. And I'm sorry, I'm a bit of a numbers guy. That's why I moved from to agent side to the lending side. I love putting the pieces together on the puzzle and making.
I know, I love it. I'm just like, I'm so excited. Like, I know this out. God, I feel like such a nerd. But I'm like, guys, this is huge. That is a huge thing.
And to be able to say, my wife usually talks to the clients, and if it's not you directly, she talks to the real estate agent.
I mean, so she's a little bit.
She's
prettier,
always
so
telling me, she's more fun to talk to. She won't bore you to death with the numbers, because she always asks me, well, what are you talking about here? You know, and we do this together. But so that segues right into the fresh start DSCR. Usually you have to have experience. You have to have, some places require you 3 properties if you're doing fix and flips, or some of them even have to have rental history over 2 years of rentals. Well, this investor right here, they offer a fresh start DSCR. So this is for anybody who's brand new to investing. You want to do your first property. Okay, they do have a little more. They won't loan you quite as much money. They won't go down to a 0.75. They do a 1-to-1. So you can go buy a property, you know, that's gonna generate $1,200 a month in your payment. Yeah, that's all.
And guys, and I'm gonna tell you, like, God, Joey, I am so sorry, but like, I
love you.
Over the past like 2 weeks, guys, I've got a bunch of money I need to deploy. I need to go buy some more houses. I am telling you, every single solitary house I have looked at has been essentially a break-even deal. I cannot find anything that's cash flowing real sexy. Now, here's the problem. This has been going on the East and West Coast for a long time, and I've talked to a lot of my investor buddies. They say, buy it. Even if you're bleeding a little bit, like if you're at a 0.75, if you're experienced, it's okay. You just need to be able to handle that loss for about a year, and then everything's going to jump and adjust, and you're going to be fine. So this fresh start thing, guys, on a 1-to-1, it's perfect for the San Antonio area right now, or, you know, anywhere in Texas, really, because we're just growing like crazy right now, and it's getting harder and harder to find something that cash flows.
Yeah, I mean, if you can get in. Autumn and I have rented one of our rental properties we rented it to our daughter and our future son-in-law, and we're kicking ourselves right now because we gave them a little bit of a break, and right now we could be renting for $500 more a month. So they're coming up on their renewal, and we're like, I don't know if we really want y'all to stay there or not. Come on, man. And so about the only big thing on like a DSCR, even for a fresh start, is they want to make sure that you're not going to live in the property yourself. So they will require either that you currently own a property or that you can show that you've been renting. If you're living with somewhere and you're not paying rent, if you can get some kind of letter, anything that kind of shows a transfer, or that you're in, you know, staying somewhere, that you're not going to buy this as a term and investment and then move into it. So that's the only real thing to look out for. And so same thing, the fresh start is just going to lower your numbers a little bit more, kind of tighten that box a little bit. Not too bad. The rates are a little bit higher. But for your first property, to get in, find a good property, get your feet wet and learn, it's a great opportunity. So a fresh start DSR is something that we do allow. This particular lender, AmRes, they have quite a few. They have, like Colin was talking about, almost exactly what he's doing with the hard money. We call it primary residence bridge loan. So I'm sure you guys get this a lot that are doing even more conventional, is hey, yeah, you know, I've got a lot of equity in my house. I got $100,000 equity in my house, but if I sell now, where am I going to go? Well, this is the answer to that. This is a primary residence, basically a bridge loan. They're going to take that $100,000 equity, and they're going to basically give you a loan so you could go buy your next house before you sell. you sell your current home. So you can go ahead and get out there, get in before, before that $200,000 house is 250 in 2 years. So
Yeah, and guys, so just real quick, whenever you hear the word bridge in conjunction with a loan, it's intended to be temporary.
Temporary, yeah.
Okay, this is not a 30-year loan.
No.
They tend to be about a year max. Am I right on that, Joey?
Yeah, year max. I did see one yesterday that was a 2 year, but usually a year. And you don't want to stay there that long because you see rates are starting at 7.99%. So you don't want to be paying that much. But it does give you, a nice 4, 5, 6 month window if you need it. And again, they're looking. You can see no income needed, no source of or seasonings of funds. What a seasoning of fund is when the bank asks you, hey, you just got a $50,000 deposit. Where did it come from? And then you have to go back and show the whole trail. Or, hey, where did this $5,000 come from? So they don't really care. As long as you have the money and it's accessible, you can get it. They do require, like on this one, they require a 6-month reserve. So if they're to make the interest only. So, if they're going to lend you the money, they want to make sure that you're going to pay it for at least the 6 months, because they figure you're going to be out of this loan in 6 months and you're going to be doing just a regular financing loan. Another program is our fix and flip. We do fix and flips. Big on the investor side, huge on the effects. And this is again another this is a short-term loan. You're gonna buy a property. It's gonna be based on the ARV, the after repaired value, and so they're gonna loan you the money. They'll even loan you some money on the repair side for the repairs. And they vary. There's some that are, like I said, I've done a few hard money loans before I got into the mortgage side, and some people will loan you better than the 65% ARV. But it's an option. There are some options. I do have some different investors that do this. I like this AmRes Corporation. I really like them for their DSR product, and they do have some bank statement programs that we like to use as well. And then there's another one that's not quite a fix and flip. It's your one-time fix to rent. And basically this is a combination. It's not your DSR where your house is ready to be rented and needs just a few repairs to, you can actually live there and still get it done. It just needs some updating. This one needs a little bit more of an overhaul. It might have something, take you a couple months to do that somebody can't live there. Like maybe it needs a new roof, new floors, or you have to do some major foundation repairs. But this saves you, as instead of a fix and flip loan, you're not having to run that twice. So you're not doing your short-term loan and then refinancing into another one. They're basically giving you it in an all-in-one package here. So it's a different option for our investors. There's just a ton of them that come out. They all have different numbers, different touches, but they're out there. No ratio. This one is pretty crazy. So I was telling Colin a little bit earlier, as we jumped on the Zoom. It just came out today. I just saw the email. I haven't even looked into it, but now they're doing a no ratio for an owner occupied. That's the thing. All of these, like we said, they want to make sure you have your own residence. Now they're doing no ratio for and a ratio is like a 1.2 DSCR. So they want to see 1,200 instead of 1,000. And they're all actually allowing owner occupied now for your investment properties. I guess they're seeing that the market's changing and people need to get into some of these properties that they might have owned as an investment now. So.
Dude, guys, look at the very bottom line. You can see right there, foreign nationals allowed too. That's a big thing here in San Antonio.
It is.
It's a big thing here in San Antonio. If you got an I-10 number, you can pull the rest of it off. And
so,
I-10, what is that? Something taxpayer identification number.
Taxpayer identification number.
Well, what's the first I?
International.
Yeah. There you go.
And so I actually, AmRes is a great company. I do use another company called FNBA for their I-10 program. Awesome program. And I use FNBA also for your bank statement, like Colin was saying earlier. I have one guy, and this is how crazy the box gets. The government box. He worked at a company for 5 years. A competitor came and poached him and promised him all this stuff. He went there for 8 months, decided it's not what he wanted to do. It wasn't what they told him. Came back to his previous job in the same role, making the same amount of money. He's been there for 90 days. He got denied by another lender. So the real estate agent sent him to me. And of course, we got him approved. We used the bank statement program. We could see that he was making the same amount of money. And, you know, I don't understand why they would not approve you, but because of that quick little income gap, or income change, he didn't fit the box for a government loan. So we just moved him into a different program. So,
Yeah,
and that happens all the time. So
yeah. Oh God, all the time, all the time.
Yeah.
We tried a while back. We tried to refinance our house, and my wife had just changed jobs, and we were catching hell for that. And you know,
right,
it's exhausting.
And then this is closer. This is closer to your actual, a little bit closer to a conventional loan. This is right outside of the QM box of a qualified mortgage. You basically you'll have some documents. You have, you know, people that have their W-2s and they're going to have tax returns and stuff like that. They're actually going to look at what you're doing personally and not just the property for a streamline loan. And then they've released this one. I also have another lender that just released a mixed use property going up to 8 units. Typically they like to keep it between 2 and 4, because once you got above that, you're looking at more commercial. But you know, they'll do up to 8 unit properties, and the DSCR down to a 1-to-1 ratio, which is great. 75% LTV, and then if you're cashing out 70%. So. And
yeah, real quick, guys, real quick. I don't know if you were looking closely at all of these things. One thing, Joey,
yeah.
I know what he's talking about. And I apologize if I'm slowing you down, Joe.
No,
but guys, typically, if you're doing a cash out refi, like, hey, I want to get cash in my hand when I'm done, they're not going to lend as much of the value. The loan to value is going to be a little bit lower. If you're going to leave it in the house for some reason, they're okay with it. It doesn't make any damn sense to me, but whatever. That's why they do that, guys. It's a little bit. And real quick, another thing that I want to point out that I saw in a handful of them, I don't know if it's all of them, you know, we're kind of talking quick here, is a lot of these, no, it's okay. A lot of these more creative financing loans, guys, something you do need to be aware of, and Joey, I want you to speak more to it, is that there can be a prepayment penalty. Most of them are that they're step downs. I'm in the middle. I have a DSCR loan on one of my properties right now. That's a 5-year step down. So if I sell it in year 1, I owe a 5% penalty of what I owe. So if I owe $100,000, I owe an extra $5,000. It becomes 105. The second year, it's a 4% penalty. In 3, 2, 1, it steps down every year. I saw in one of yours it was a 3% penalty. So that's just something to educate the agents out there, guys. That is something you need to be thinking about and ask that question. Because these creative programs, when they're getting creative, guys, they need to make sure, really sure that they're getting paid. They need to make some money, because, and that's how they kind of get you. That's the gotcha. What's the catch? That's typically it.
And that is typical. It is very typical, because they're not asking for, like Colin said, they're kind of protecting themselves a little bit. Hey, we're going to put you in here, but we need to make a little bit of money to make our money back. And so 5 years, 5 years is a pretty standard one. Most of them, if you'll do at least a 3-year, they'll be good. If you start trying to go down to a 2 or 1, then you're going to take a rate hit. So instead of your rate being a 5.5%, and you're trying to do a 2-year or 1 year, they're going to see that as increased risk. So you might be paying a 6 or 6.5%. And then the prepayment penalty usually is a step down. If you have a 5-year, if you sell within that first year, it's a 5% that you pay off of the loan. It's a 4% if you do it in year 4, year 3 down. But at most of our investors, they'll ask for a 3-year, and if you give them a 3-year, your rates will be fine. If not, then your rate will come up if you're using a 2 or 1 or 0.
Yeah. So. And then another cool thing that I'm seeing, and I'm sorry to interrupt, is a lot of these things, you know, they're based on the house. You know, they want to dig through your credit, but not so much your dirty laundry. So Joey, when we were talking yesterday, he kind of made a funny comment. I thought it was pretty funny, because he said, he goes, this is not like Mary Kay or something like that. Your friends are probably not going to come to you. You know what I mean? It's like, I don't want my friend to know how much credit card debt I have, because, you know, I did something bad, you know. And guys, it doesn't come up. I mean, they're going to see it for a hot minute, but it's not something that they really need explanations on. So that's another really cool thing
Yeah, they're and yeah, that's when I got into mortgage, my mentor and my broker told me, hey, your friends aren't going to use you, man, because they don't want you looking and seeing that, hey, they go out to the bar every night, spend $50 every week at so and so, or or they're still paying on their wife's diamond ring that they say they bought for cash, because that they dig through it with a fine-tooth comb and underline you. Here we're pulling credit, and usually we're looking for any kind of lates on a mortgage. That's the big thing. Is if there's mortgage late recently, they just, then we need to know why. And it depends. Different ones they'll do. You'll see it, and it'll say a 0 by 30 by 12, and that means 0 mortgage lates over 30 days in the past 12 years, or 12 months. Some of them I saw on one of these is a 1 by 60, so that means you could have one mortgage late over 60 days within the last 12 months, is what they're looking for. And that's kind of just, it's another way. They're not going to go through your finances with fine-tooth comb. They're looking mostly at the property, but they also just want to make sure that hey, you
And of
have
course,
some skin in the game, and you're responsible. So,
and of course, foreclosures,
yes.
deed and lose, that kind of stuff.
Yeah, and we do have specialized programs for that. We have lenders that'll lend one day out of a foreclosure. They'll lend one day out of a bankruptcy discharge. And you're going to pay higher rates, and you're not going to get, your 95% or 90% down, like you will on your government loan. But, if you have somebody that something happened, they went through a divorce maybe, and they had to do that. So coming out of that, we can do that. Colin touched on the foreign national program. It's a big thing. It's a real big thing, because a lot of your foreign nationals, they have the money. They're here. They own their own businesses.
They tend to be the ones that are cash heavy.
Yeah,
I got
yeah.
$200,000. Can you please sell me this house for $400,000?
Yes, exactly.
Nope. It's like, why? It's so, it doesn't make any sense.
And again, it's super easy. They have an ITN number, and I actually get to build their credit profile, because some bigger banks they've started giving credit cards. And so Bank of America is one that's been really good. But like, cell phone bills, rent, anything. If I can get the 5 trade lines, 5 issues of credit, whether that's you're paying for your wife and a husband's cell phone, you're paying your cable bill every month, your Netflix bill, then it's pretty much a regular loan. And a lot of those people are cash heavy because they have their own businesses, because they're not getting W-2s. Same thing. I have another one I'm working on right now. He has W-2s. He's paid himself. He's self-employed, paid out of his company, but he hasn't filed his taxes in 2 years for some reason. Well, that's okay. We go to a bank statement program. They see that he has his 2 years of W-2s. They get his bank statements for the last 3 months. Yeah, no big deal. So move on down the road. If that was trying to be a QM and in the box loan, there's no way that it would happen. But right now he's taking advantage of his equity, and he's getting rid of his PMI that he had. So a lot of people are doing that. So it's a way. If you have anybody who's willing, you qualified them, as being a willing person to do it, we'll find a way to make it work in almost every situation.
Guys, that is so huge. I mean, I'm actually really mad that I didn't know Joey was doing these kind of things till last week. I'm legitimately upset, because this would have helped. I can think of at least 6 clients and myself personally. So Joey, get ready. I'm about to wear you out.
Yeah, let's do it, man. And my wife, she's come on to help me. Like I said, she's much better to talk to clients.
Your wife needs to come on to White Line, but we're going to talk about that.
Hey, and we were talking about that last night, because I said, hey, like, I think your line was awesome. Hey, I don't know a broker out there that offers a 401k, so we teach you how to make your own money for retirement. And
exactly
that's a great, getting into real estate is awesome. And especially now, I went the hard money route to get one of our properties, and paid the 12.9% interest rate, and paid 3 points up front. And, it was expensive. It was real expensive to get into it. But I didn't know all these options were out there, and a lot of people don't. And this is how the people on using the Burr method and on bigger pockets, that's how they're getting in there. They're finding the creative finances ways, and there is creative finances way, especially in today's, rapidly changing market. So.
Yeah, it's been nuts. I'm sorry. Keep going. We're at no ratio. I think I'm sorry. I'm interrupting. I'm excited. Legit. Like, this is the weirdest thing I've been excited about in a long time.
Yeah. So the no ratio basically is they're not doing the 1-to-1 ratio. This one's kind of it's a little bit of a one-off, but they're going to look at the property. They're going to come up with their own idea of exactly where it's at. It doesn't have to meet the 0.75 minimum or the 1-to-1. And so they don't have a prepayment penalty on this one. And again, they're still looking at the property. They're only looking at your income and your credit score to make sure that there's nothing crazy out there. And they can do it really fast. This one costs a little bit more to do a no ratio. But it's another option to where they're not going so much just strictly, and this is a little bit more, instead of outside of the box, it's another step outside of the box. So and this is just one of our lenders. I picked them because they have, I do send quite a bit of stuff to AmRes, and they're really easy to work with. I think we touched on the STREAMLINE. This is closer, if a no ratio is a little one step on the other side of the box, this one's almost a step to the QM, is they do look at kind of your standard LTV. They're going to look more at your income, so they're going to look for mortgage rates. And you can see at the very bottom, minimum of 6 months payment on your current mortgage, a 0-30 by 6, which basically means no late payments on your mortgage over 30 days within the last 6 months, which is still pretty easy, because usually a QM loan is going to be a 0-30 by 12 or a 0-30 by 24. And so anybody that's had that recently, something came up, maybe they got laid off during COVID and now they're back to work, they're not going to qualify for your normal mortgage. So, send them our way. We have tons of programs that'll work with them. And we'll get them in on something.
So a lot of these, man, I'm seeing minimum credit scores around 620.
Right.
It's kind of, this one says 680 here. I think a bunch of the other ones said 620. What do you do, if I bring a client in that's, it's 600? Where are we at there? 600
is fine. It depends on kind of what they want to do. We'll lend all the way down to 500. And that's your standard. That's a QM loan. That's a FHA loan. I can go down to 500. Now they do have to have 10% down. So, because if you're at a 500 credit score or 510, 515, you're going to have some recent history in there that a bank's going to look at and be like, yeah, that's pretty risky. So we do ask for 10% down. Anything below a 580 is going to have 10% down, but we will loan on it. So, and that's the big thing. The big qualifying thing is the lates on mortgage. Anything that's in an active collection, we do have to count as part of their debt to income ratio. And your debt to income ratio is almost exactly the opposite of what we talked about for our newer agents on the DSCR, where they're comparing potential income of the property to the actual cost. It's comparing the amount of debt that you have personally or your borrower has to the amount of income that they have. So the real area that kind of starts getting a little bit into the weeds is when people start getting above 35%. So that means if they make $5,000 a month, they can't have more debt than about $1,500 a month is when their ratio starts kicking in. So, and that's pretty hard to do, when you're looking at, payments on cars and just, we had one underwriter, a little bit of a funny story. We always start telling war stories and these type of things, but she's starting to calculate. She was calculating how far away from their job these people live because gas was $5 a gallon. And so she was starting to put that into their debt to income ratio, just because it's a major expense now. So needless to say, we asked for a different underwriter and move that loan to a different.
Yeah. And the analogy I always use for this, Joey, is I always tell everybody whenever I'm working with a client, I say, hey, listen, Joey's your friend. He is like your loan originator is your friend. They are the ones that are going to dig through all your stuff. It's going to seem a little, it's going to seem pretty personal, but they are going to fight the dragon, and the dragon is the underwriter. So you need to give them every tool they have to go fight the underwriter. I've said this before, and I'll say it again. If I walk to a party and somebody's like, "Oh yeah, I'm an underwriter," I'll probably punch him right in the throat. I get so. I was like, how, because they do crap like that. I'm like, why would you even?
Yeah.
How do you know he's not using public transportation? Screw you. Like, what? I don't know. Maybe
that was the joke. Is hey, go get a bus pass, take a picture of it. We'll fax it into him.
Yeah, right. I was like, you know what? It's like, come on now.
That's what I use. So, and that another point is that's we're here. We work on commission only. So Autumn and I, we don't get paid unless you get paid. So we're looking for ways to get people approved. We're looking for ways to make sure people get into houses and that their offers get accepted. And we do it by having so many programs. When I first started, I worked at a really small brokerage. We had about 10 different lenders, and that just wasn't enough, because right now, if I'm used to sending stuff to AmRes, and for some reason their turn times move from 25 days up to 45 days and we're not getting deals closed, I'm just going to move it to a different lender. I can pull it out from the lender in the middle of the transaction and say, hey, we're going to go over here to Quotonic, and that's where we're going to take this loan. So
dude, it's like, man, guys, you like that's the other thing with the broker. Like, I mean, he can literally he's like going, but he's already got your file, and he's like, you know what, I'm tired of this, and he goes to the next one. Or maybe he runs them concurrently. Maybe he runs them with five different people concurrently, and we're just like, show us what you got. Let's see if we can get this thing going.
You sent me that scenario last night, and that's what I did. I sent it out to the 4 people I use a lot for. And so this is the one I was talking about that came across a little bit earlier this morning. It's a no ratio owner occupied. And I've never heard of them doing an owner occupied. I still don't understand what it's for.
I don't know what it's for. I don't get it either. But guys, just the title on that right there, if you don't get excited about that, like you it's okay not to understand it, but you need to call Joey. I'm gonna put Joey's phone number real big across the bottom of this thing. Joey, sorry, cell phone number. You can call him at midnight. Just do it.
Yeah. And so, I mean,
it's huge.
Just trying to think of what it's used for is somebody that needs to get into a home. They have a little bit of cash, and there's no income verification. There's no employment verification. They're not calculating their DTI. So maybe you have somebody that has cash, but I had one guy that recently he signed on a loan for his friend, and his friend's car payment is $992 a month. I said, bro, that just killed your DTI. I said, you don't qualify for anything that's in QM. We're going to have to go to an outside the box program. So maybe something like this would be a good option for him. He's out house shopping right now, but this might change it a little bit, and he might qualify for a little bit more. Not going to pull W-2. So, I guess, it's just released. So maybe this is an answer to rising interest rates and rising house cost is that they're seeing that people can get in here with a little different program. So I'm excited about it. I'm just trying to figure out where we can apply it to help people out. So.
Yeah, I'm going to make 2 more statements, and I feel bad. I feel like I'm trying to hog the mic here because I'm so jacked about this. But guys, so there's 2 things that get me really excited right off the bat, and one of them is personal. Okay, this is Colin. This is a personal problem that I'm running to that Joey just showed me that there might be an easy solution out of this. And from the investor side of things, I think y'all have heard me talking about my 4-plex that I've been working on. Guys, when I bought this 4-plex, it was down to studs. There has been literally, Eric and I were talking yesterday, and he goes, dude, I never would have bought that house in the first place because I was boohooing about how big of a pain in the butt it is. The good news is I got a lot of people offering me a lot of money for this thing, and I can't believe it right now. But what's interesting, guys, is that when you get a hard money loan, you got to put so much down. They finance the rest, and they tend to do 100% of rehab, right? That's a hard money loan. I'm paying 9% interest only on this loan, okay? And I've been paying that every month for the last 10 months. You have 1 year. It is a balloon payment at the end of the year, guys. Yeah. And so as of May 1, I've got to be out of this loan, okay? Now, if I am not out of this loan on May 1, I'm in default. So now that's not going to look good on my credit, okay? So what they do is they offer you a 1-month extension for 2 points. Guys, wow. I've borrowed $300 and something thousand on this thing. So they're going to say, hey, we'll give you an extra month for $6,000. $6,000 for 1 more month to figure your act out. But what I'm hearing right here is if I am half an inch from the finish line, Joey can refinance this thing for me. And he's got a little bit of a bridge in here where it's not that big of a deal, and I'm not having to pay all these points. And that's it, like literally the stress, because I'm over there like yelling at the contractors. Yeah, like what? And they're like, the power's not on. It's the city now. It's a list of problems. Oh, yeah. But like, so, like this takes the pressure off of me, guys, to where I, now I'm going to make a $2,000 payment versus a $6,000 payment. And so that's really, really good. And then the other thing is we've all had clients, guys, all of us have had clients that miss out on a qualified mortgage by some stupid regulation,
Yeah.
something stupid. And what he's saying right here is, we got you.
Yes, sir.
We got you.
Yeah, I have an investor, a lender partner that we use exactly for that. They call it the NONI. It's basically, it's a near miss is what they call it. It's just for some reason they just missed out just barely. And so it's very, very similar to your standard, FHA, VA. I mean, it's really close. It's just, it's not right there. So
I can see a loan originator, an underwriter being like, "Oh, can't help but notice you drive a red truck. So red trucks need higher insurance rate.
Yeah.
I'm going to have to take that into consideration."
Yeah. So
anyway, sorry, go ahead, Joe. I know we're running up against time. So
yeah, and I just want to touch on another one. We talked about DSCRs. I'd love to come back. I've got more that we can talk about. There's tons of these things, and we put them together. This is our light doc investor. So this isn't a DSCR program. This isn't looking at the actual property.
And what does doc stand for?
Is for document. So that's going to look at your standard. Like here, if you're self-employed, it's going to look. You can actually, this doesn't. And this is great. Y'all might not understand how cool I think this is. I'm kind of geeking out, like Colin's been saying, that a 12-month borrower prepared P&L. That means that you don't have to have a CPA prepare this. And so many places require a CPA to have prepared your P&L. So this is for somebody.
The term you'll hear, guys, is audited. You'll hear an audited P&L. That's the term you'll hear. So that's the difference. Sorry, I'm just making sure they know what
and
the difference here.
And so no tax returns required or W-2s, but it's not a bank statement program. They're basically going to look at the P&L that you prepared, and they're going to look at your history, because you can see the property doesn't need a positive cash flow. So this is for somebody who doesn't want to do a DSCR program. Then maybe they haven't done a ton of investments, but they want to get in somewhere quick. They're going to use it. They don't have the time to spend 3 months working with an underwriter to come up with, pick through everything. So they're going to look at your P&L. They're going to look at the property, and they're going to check out your debt to income ratio. So this is based off of you, not the property, but it's a lot easier verification and a qualification than going through every single step and providing bank statements and pay stubs and W-2s and income tax returns. So it's an easy way to get in somewhere, especially for a new investor. So
it's unbelievable. Talking to Joey last night, guys, for 5 minutes, I'm like, "Hey, look at this property now." I sent him one. I'm about to send him a second one. I got that sixplex I'm probably going to send you in a couple months. I'm about to wear you out, Joey. And I'm going to tell all the agents that are watching this video right now, guys, you have got to talk to Joey.
Yeah.
Because
and don't get me wrong, man. We do VAs, we do FHAs. It's the same thing. I've picked about 3 for each. We do down payment programs. We do a lot of down payments. When Autumn was a real estate agent, she did a lot of down payments. She was a teacher, so she knew what it was like. She used down payment assistance to buy her house. But we went through the same thing with an underwriter. They said, "Hey, where did you get this $50,000 to cover your down payment?" She goes, "Oh, from the guy that's 1099 and my husband that you said doesn't qualify for the loan. He just put the money in." So, we have all kinds of stuff we do. We have all your standard stuff, but I know if you've been doing properties, you probably have a good relationship with those people. But the people that are just missing out, or, I really like the investing side. I'm not as experienced as a lot of you guys are, but, I love it. I love the number side of it. So, let's run some scenarios together. Autumn likes going to open houses. I tag along usually to put out the signs. That's what they make me do. Go put out the signs while we get everything set up. So we'll help you out with open houses.
Highly specialized word. Do you do balloons? Do you do balloons? You better be putting balloons on those signs.
Balloons. I haven't quite got the helium down. Maybe I like to drink a little bit too much of it, so it makes a funny voice. So any way we can help you out.
What you talking about?
What are you talking about, man? So.
But, awesome, guys. Yeah. I'm gonna put all Joey's contact information on this video. I'm gonna put a little something on it, so I don't even know why I'm telling everybody this, but you got to give him a call. But ladies and gentlemen, I do want to say one thing. Love Joey, great guy. Known him for decades. Okay, he's a fantastic guy. I do have to put in here at this caveat because it is important, guys. As you're going out and talking to your clients, you cannot tell them that they have to use anybody. It's their choice.
Right.
Okay. And so I would definitely, I've got loan originators. I've talked about Aaron before. I've talked about a lot of these people, a lot of different people before that I really know, like, and respect. but this is a very unique situation about what Joey can do. So make sure you give your clients options. I would just make real sure that one of those options is Joey. This is some fantastic stuff. And
please don't do that, man. I wouldn't want that done to me. You know, if you have a relationship with somebody, especially if they're good at doing something, continue to use them. Continue. You know, if you have somebody that's great, I have friends, you know, that I've made that are LOs that I'll tell somebody, hey, you know, go use him. He's great at doing VAs. Do your VA loan with him. He gets the best rates no matter what. So.
And I'm going to tell you right now, guys, the reason I'm geeking out is I talk about this stuff a lot. It is something that I deal with all the time. Money, right? That's the thing that we have to deal with. This is some of the sexiest loan programs I've seen in a very, very long time. So it's going to lean that way for me, guys. But you got to give your client options. And as a gentle reminder, if somebody's shopping for a house and they go apply for a loan, that's considered a hard credit pull. They are going to dig through your dirty laundry. Once you've done that, guys, and Joey, correct me if I'm wrong, you've got 30 days to take as many hard pulls as you want. You're going to take about an 8-point credit hit for that 30 days. Like if you're an 800, you're going to be 792. Okay. But that's just because you pulled that, and it's going to last for about 30 days, and they're going to tack it right back on. It's not a big deal. But during that 30 days, you can pull it with 700 different lenders. Nobody cares because they know you're shopping. So give your client options. I highly recommend that you give Joey as an option. You know, pick some different things. People are good at different things. I've never heard of anybody that has 1,600 loan programs. That's
over
a lot.
4,000 loan programs.
4,000.
I can't even fathom that. I know we have 100. I think it's 168 or 69 different lenders, and I talk to about 20 to 25. You know, that's just way too many. I find out what I need, and then if somebody's not doing what, you know, if we've been working together and they've kind of started dropping the ball, then I'll go search for another one. So yes, I do we do shop as a broker, but you know, it's almost impossible to shop 169 different people when you're trying to get an answer back. So we'll shop 4 or 5 at a time and figure out what's the best solution there. So.
Second is that. Joey, I can't thank you enough for your time. I know I'd let you get out there. I'm hungry.
But thank you so much for having me.
Yeah, absolutely. And like I said, get ready. I'm about to blow you up. So
all right.
Hopefully I can keep you busy for a minute.
Yes, sir. Thank you so much.
All right, Joe, you have a great one, and I will talk to you very soon.
All right. Take care.